Good morning. Today is September 22nd. Let's get started. Now, the financial firm that created the security might negotiate with the credit rating agency asking, what do we have to do to get a AAA rating? There would be negotiations and discussion, and in the end, the security would be rated AAA. The financial firm could then cut off the security in different ways or sell it as is to investors, such as pension funds. But again, financial firms kept many of these securities on their own books or in related investment vehicles. And finally, on the right in the figure, you have credit insurers such as AIG and other mortgage insurance companies that for a fee provided insurance in case the underlying mortgages went bad. So this is the basic structure of the securitization process. I have seen complete flowcharts, and they are incredibly complex. This is a very simplified version, but the basic idea is there. As you recall, a financial crisis or panic occurs when you have any kind of financial institution that has illiquid assets, long term loans, for example, but liquid short term liabilities, deposits, for example. In a classic bank panic, if bank depositors lose faith in the quality of the assets held by the bank, they run and pull out their money. The bank cannot pay off everybody because it cannot change their loans into cash fast enough. And so the run on the bank is self fulfilling. The bank will either fail or have to dump all of its long term assets quickly in the market and take big losses. The crisis of 2008 to 2009 was a classic financial panic, but in a different institutional setting, not in a bank setting, but in a broader financial market setting. As house prices fell in 2006 and 2007 for the reasons I described, people who had subprime mortgages were not able to make the payments. It was increasingly evident that more and more were going to be delinquent or default, and that was going to impose losses on the financial firms that investment vehicles they had created sorry the investment vehicles that had they the investment vehicles they had created, and also on credit insurers like AIG. Unfortunately, the securities were extremely complex, and financial firms' monitoring of their own risks were not sufficiently strong. The problem was not just the losses. If you put together all the subprime mortgages in the United States and assumed they were all worthless, the total losses to the financial system would be about equivalent to one bad day in the stock market. They were not very big. The problem was that they were distributed throughout different securities and different places, and nobody really knew where they were and who was going to bear the losses. So that created a lot of uncertainty in the financial markets. As a result, wherever you had short term funding, whether commercial paper or other types of short term funding, the lenders refused to lend. We had all kinds of funding that was not deposit insured. It was so called wholesale funding, which came from investors and other financial firms. Whenever there was doubt about a firm, as in a standard bank run, the investors, the lenders, and the counterparties would all pull back their money quickly for the same reason that depositors would pull their money out of a bank that was thought to be having trouble. So there was a whole series of runs which generated huge pressures on key financial firms as they lost their funding and were forced to sell their assets quickly, and many important financial markets were badly disrupted. During the Depression, thousands of banks failed, but almost all of them, at least in the United States, were small banks. Some larger banks failed in Europe. The difference in 2008 was, in addition to the many small banks that failed, there were also intense pressures on quite a few of the largest financial institutions in the United States. Let's look at some of the firms that came under intense pressure. Bear Stearns, a broker-dealer, came under intense pressure in the short-term funding markets in March 2008 and was sold to JP Morgan Chase with Fed assistance on March 16. Things calmed down a bit after that, and over the summer, there was some hope that the financial crisis would moderate. But then in the last summer, things really began to pick up. On September 7th, 2008, Fannie and Freddie clearly were insolvent. They did not have enough capital to pay the losses on their mortgage guarantees. The Federal Reserve worked with Fannie and Freddie's regulator and with the Treasury to determine the size of the shortfall. And over the weekend, the Treasury, with the Fed's assistance, placed those firms into a form of limited bankruptcy called a conservatorship. At the same time, the Treasury got authorization from Congress to guarantee all of Fannie and Freddie's obligations. So the firms were in a partial bankruptcy, but the United States government now guaranteed their mortgage-backed securities. So that protected those investors. That had to be done, or else it would have been an enormous intensification of the crisis because investors all over the world held literally hundreds of billions of dollars worth of those securities. In the middle of September, Lehman Brothers, a broker-dealer, had severe losses. It came under great pressure and could not find anybody either to buy it or to provide it with capital. And so on September 15th, it filed for bankruptcy. On the same day, Merrill Lynch, another big broker-dealer, was acquired by the Bank of America, basically saving the firm from potential collapse. The next day, on September 16th, AIG, the largest multidimensional insurance company in the world, which had been selling credit insurance, came under enormous attack from people demanding cash, either through margin requirements or through short-term funding. The Fed provided emergency liquidity assistance for AIG and prevented the firm from failing. Washington Mutual was one of the biggest thrift companies, a big provider of subprime mortgages. It was closed by regulators on September 25th after parts of the company were split off. JP Morgan Chase acquired this company as well. On October 3rd, Wachovia, one of the 5 biggest banks in the United States, came under serious pressure and was acquired by Wells Fargo, another large mortgage provider. All the firms I'm talking about were among the top 10 or 15 financial firms in the United States. Actually, Lehman Brothers was at the second, as far as I remember. And Bear Stearns was fifth. Similar things were happening in Europe. So this was not a situation where only small banks were affected. Here we had the largest, most complex international financial institutions on the brink of failure. Let's review the lessons from the Great Depression, which I discussed in the first lecture. First, the Fed did not do enough to stabilize the banking system in the 1930s. And so the lesson there is that in a financial panic, the central bank has to lend freely according to Bechet's principle to halt runs and to try to stabilize the financial system. Second, the Fed did not do enough to prevent deflation and contraction of the money supply in the 1930s. Back then, there was gold standard. So the second lesson from the Great Depression is that you need to have accommodative monetary policy to help the economy avoid a deep recession. So heeding those lessons, the Federal Reserve and the federal government took vigorous actions to stop the financial panic, working domestically with other agencies and internationally with foreign central banks and governments. Now, one aspect of the crisis that I think does not receive enough attention is that it was global. In particular, Europe as well as the United States was suffering very severely from the crisis. But it was also a very impressive example of international cooperation. Back then, the impact on South Korean economy was not that much severe because the financial development and structure, the financial instruments were not developed in South Korea. So that was that. More developed financial system in a country more severely suffered from the 2007 to 9 financial crisis. On October 10th, 2008, well, let's stop there. And let's continue next time from October 10th of 2008.